This part of the program is entitled Building Financial Projections, and so so it's numbers and stuff. But why do you do that? Well, you heard Rich Kivel talk about different business models, and when you're thinking about different models, you got to think about what are the resources, and that includes people, money, etc. So if you are a taxi cab company, you got to figure out, do I have to buy, or let me do Airbnb, right? If you're Hilton, you got to own or somehow get all the rooms that Hilton has. And Airbnb, and that has a whole bunch of financial consequences. Airbnb doesn't have to do that. Their model's different, and they have different set of needs and responsibilities. And the question is, can you figure out what those are, and how do you sort of model those to be part of the idea that you have and the plan you're going to implement? So tonight we have Steve is going to come up, and he's going to tell us how to do all of that. Steve Derezinski, thank you.
Thank you. Can you guys hear me okay? I did just catch the last bit of Bob, and now I'm going after Bob. So you guys can criticize me and send me emails about, well, you didn't follow this and didn't follow that. So hopefully you can hear me okay. We love Bob. He does a great talk, but I don't think I follow all the things that he's recommended. And I'm not plugged in here, so hopefully we'll have enough power the whole time. Great to see you guys here on a cold, is it Tuesday or Wednesday night? I forget what day it is. We're going to talk about building financial projections, but a little bit about myself. I got my undergraduate here in mechanical engineering, mostly robotics. I have a patent on the space shuttle's robotic arm, which kind of dates me, so like the space shuttle doesn't fly anymore. But anyways, it's on there. And then I came back and got an MBA from Sloan as a Sloan Fellow. So that's where I've got my foundation in sort of physics and engineering, and then the sort of greedy financial guy from Sloan. How many Sloanies are here? I mean, and I say this in term of endearment, like I am a Sloanie, so you guys. Before I came back to Sloan, I was down at Georgia Tech, and I ran something called, I was actually the first managing director that created Georgia Tech Venture Lab, which is the first faculty spin out in 2001 or 2000, and that predates the MIT one. So whatever it was called, what's it called? Anyways, that doesn't matter. And now I'm running Kendall Square Co-Foundry, forming multiple companies. But before I get into kind of the details, I wanted to get a sense from you guys. How many people would consider themselves technical? Like biotech, AI, all that stuff. That's who you are. And how many people would consider themselves an MBA or like a business person? Or do we have any like pure finance people that think they're finance? I know Taylor, you are one, so you have to raise your hand. Anybody else who's just pure finance? And okay, and then the other question is, and Taylor, you don't have to answer this one. Does anybody have any accounting experience? Like, like green eye shade accounting, like counting stuff? No? Sort of, a little bit? Okay, good. Because I want to tell you a quick story, because as an engineer, so I've founded a whole bunch of companies and raised a bunch of capital, and they're all technical in nature, but as an engineer, you're always sort of focused on the principles. What's the nature? What's the physics engine? What's the material science? What's the ion equations that are sort of driving this core, physical phenomenon that I'm looking at? And that's the ultimate sort of source of truth for what you're looking for. And when I started my very first company, I have a good friend who's a CPA, and I was trying to understand finance with him. This is a long time ago, okay? And I kept asking him, like, why do we do it that way? Why do we do it that way? And he finally just put his pencil down and he said, Steve, accounting is a man-made science. We do that way because we say that's the way it's to be done. And that sort of opened up a lot for me. I was like, oh, now I get it. So if something totally doesn't make sense, there's probably some super long historical reason why they do it that way, and you just have to kind of push on and move on it. So I think all you guys who have MBAs, or anybody who's in liberal arts or like laws, laws are sort of a collection of what we agree is the right thing to do. So that's how I sort of come to finance. So you're not going to get a finance lecture from a finance guy. You're going to get a finance lecture from an engineer. So I'm going to come at it from an engineering perspective. So if you guys have technical questions about why the heck do we do finance certain ways, I'll try and answer it. But more than likely, I'll say, why don't you ask your accountant? So okay, let's get into it. this is the agenda for today. We want to talk about business plan, financials. I should point out that in the on the web page, there's a link where you can download the spreadsheet. Does everybody see that? Do we already know that exists? There's like a spreadsheet that has the standard financials. I'm going to dive into that later in the talk, so if you guys want to get that now. There's also an equity spreadsheet in there as well. It's really well organized, as it's been beat up for many years, so it's a great place to start. You don't necessarily have to stop there. You don't have to necessarily use that completely all the way out, but for this exercise of this lecture, it's a good thing to have next to you. So, okay, so we're going to talk about what VCs want, teeing off what Bob was referring to. What is a business model, and then how do you build your financial projections for your business, and then finally we'll end up with sharing your pie or the equity discussion. So how many people have a startup company and they know what their equity distribution is going to be? Oh, a couple. All right, good. We'll have a couple examples we can talk to. Good, that's good. And then everybody else, you're just going to stare into the abyss and figure it out when you get to that point. Good. Okay, so why the heck do I need financials? This was totally me. This is probably you guys too. I'm too busy to do this stuff. I know it's going to be wrong. So by the way, what we're going to talk about is pro formas, right? So that means I'm predicting the future of what this business is going to look like. So there's a lot of arguments about, you got that wrong. Well, I was predicting the future. Of course I got it wrong. But you as the founder, CEO, or major business manager of your business, you're the best one qualified to figure out what that future is going to look like for your business. So I want to keep that in mind as you think about these financial projections, because it's like, with all of the assumptions that I'm making, this is the best guess at what I think the future could hold for my business if you put money into my business. Okay, VCs don't believe them anyway. Partially true. We'll get into kind of why, what they look at and what's important. I have more important things to do, like I have to build my product, I've got the technology to develop, I got to go talk to customers, which is actually, that's a pretty good thing to talk to. I've got to hire people and do my team, etc. But here's why you need to focus on financial projections. Cash is the oxygen for your venture. So your body can, like 40 days without food and maybe like 10 days without water and like a few minutes without oxygen. So cash is really important to your venture, right? It's pretty obvious, but it's important to kind of remember that, especially when you're trying to do a startup with nothing but vaporware in your pockets and maybe your credit card. Financials are the scoreboard, which means like as you're growing your business, you want to make sure that you're using them to communicate effectively with your investors and maybe with your customers, but mostly with your investors about how you're doing. And you're using that language that they understand. It's also the roadmap to determine like how much are you going to need to run this business, right? So you might get that question a lot when you're out pitching investors. Well, okay, what's it going to take to get to this level? And you need to have, like $1 million. Okay, it's easy to just throw out a number, but the financial projections will give you the actual kind of hard facts around this is how I'm going to spend that $1 million and why it's going to create these moments in my scale up of my venture that's going to be real value creation events for me. And of course, the vehicle to obtain that cash, whether it's equity. If you have like a wonderful consulting business and you don't want to go talk to VCs, which I'm sure maybe there's a couple people that do that, you could consider getting debt as a way to kind of expand your business, right? That's another opportunity. We're going to focus mostly on equity here because I imagine most of you guys want to talk to VCs and raise equity capital that way. Is anybody considering anything other than VCs or angel investors? No? Everybody wants to go get angel money. Okay. The other thing is that it's really important that you understand your business from a financial perspective. So you probably understand your business from a technical perspective and from a product perspective. Do you understand the market? Maybe, that's important to understand too. But when you work on your financial plan, you're not only deeply understanding kind of how it works and how much margin you can drive and how it grows, but also that becomes the language that you use to communicate to your investors to prove to them that you understand your business. And that's a really, really important piece. So when Bob was just talking about, going to talk to investors, he sort of alluded to it, but I thought he was going to say, like what they're trying to do is figure out, can I trust this person, right? There's a really deep underlying, like if you're going to show them the financial projections and you're going to hide some things, then they have to work hard to figure it out. that's way too much time and effort for the investors to spend on it. They'll just say hard pass, right? So the more you could just be kind of upfront and honest about this is what we know, this is what we don't know, then that tends to create a level of trust with your investment community, and you can grow from there. So earlier on in the slide I said VCs don't believe them anyway. Well, they may not believe kind of the projection that you throw up, but they will push on the assumptions behind your financial projections to understand, to try and make sure that they know you understand the financial business that you're in and what you're doing. So where that comes into is a lot of probing around the assumptions. So you can show the high level financial projections, but when they ask questions about how did you get that number, and what, how many customers were you assuming at this point? What they're doing is trying to understand the depth of the financial model that you built, and where are the real trigger points, and where are the deeper assumptions that you've made when you build that out. And then of course what the drivers are. So if you want to, because any VC wants to see like a business that's growing and say, if I just inject $1 million here, this little business turns into a $10 million business, right? Like overnight. Doesn't exist, but that's the sort of ideal goal, right? Or maybe it does exist in the day of AI, maybe it does. By the way, how many people use AI today? It's okay, I use it all the time. Does anybody use more than ChatGPT? What else do you use? Just shout out the other tools you use other than ChatGPT. Gemini? Claude? What was the other one? Open code. Okay, I'll have to look that one up. Anybody use anything other than the big, the big five? Gemini, ChatGPT, Claude, and is there any other ones? Oh, Apple doesn't have one yet. Maybe they will there. Oh, okay. Meta has one. Okay. By the way, does anybody use OpenRouter? OpenRouter.ai? Yeah, that's a good tool. It's got like all the models in it. So if you're like, I don't know which one to use, I just want to, especially for those fee-insensitive clients. Those are good. Okay. And then finally, what kind of exposures and risks are there from a financial perspective? So one of the big shifts that you have to kind of go through when you're running the business is, if you guys are technical in nature, you're going to focus on the technology and the product that you're trying to build. But then it becomes, you got to reduce it to financials. And then when you have the financial model, it's a financial risk that we're talking about here. So the financial exposure and the financial risks, not necessarily the I'm going to get sued because I'm infringing on someone else's patent risk, which I guess becomes a financial risk ultimately. Failure to plan is planning to fail. Okay. So how many of you guys are all founders? Is that a requirement in this class? Everybody has to be a founder? Is anybody the CEO of your company? I mean, I guess if you're the founder and you're the only person, then you're, okay. It's your job to maintain the money flowing, maintain the oxygen supply. But you do have to understand things that are not in the traditional financial model, which is things like average selling price, well, gross margins are, cost of R&D, sales and marketing expenses, and startup capital expenses. Okay, let's see what VCs want. So this is getting into a little more numbers of what Bob was talking about. They want a 3 to 5x absolute return on their overall fund. So it's important, so the reason why I want to go through this right now is when you build out your financial models, it's going to be going through the lens of someone who's like, okay, by the way, a VC doesn't necessarily have $100 million in their bank account. They have relationships with limited partners that have promised to give them money once they put an investment in. So if they want to put $5 million in your company, they have to do what's called a capital call to their limited partners to get that money to come in. So that means the VC, when they make an investment in you, they have to turn around to their limited partners and say, this is the greatest investment ever. This is the reason why we did it, blah, blah. So they have to be fully armed with all the hard questions of the limited partners to do that. So if they give you hard questions, it's because they have to turn around and kind of defend the fact that they wanted to make an investment in you to do that. And they have to prove to their limited partners that this deal is going to give me at least a 10x return. Why a 10x return when all I want is a 3 to 5x? Because some of them they're going to get wrong. So for each individual investment they make in any one of you guys, you have to prove to them that you're going to be at least a 10x return on it so that they can get their overall absolute return in 5 to 7 years. So just in terms of the numbers, 4x over 5 years is an IRR of 32%. So if you're doing it on your spreadsheet, you can kind of see like, am I on track to kind of get that? If I've got, over 1 year, I've got an IRR of 32%, then I can keep going that rate. I should make my goal. So their requirements are to get a significant amount of money invested, significant amount of equity, I should say, for the money that they put into the business, and own a significant ownership. Now this says 50% or plus or minus. If it's over 50%, that's kind of a control player, and typically most VCs don't want to be the management team. So I know a lot of people are worried about giving up, too much control or whatever. They don't actually want to take your seat. It's a really hard job to do what you're doing. But they do have to get a very high return. Now, if they do want to get more than 50%, that's something called private equity or like a takeover, right? That would be acquiring your business. And that happens a lot, and there's a lot of exit opportunities around private equity stuff. So if you don't know the formula, it's pretty simple. The money investment or the cash investment divided by the pre-money valuation, which is the term that you negotiate with them, plus the money invested, is the actual percentage they own. So if they put $1 million in you and you say your company's worth $4 million when it's you and a technology and your hound dog in your garage, that's a pretty good deal as far as I'm concerned. So then the overall percentage would be 20%, right? 1 divided by 4 plus 1, so easy enough. Right, pre-money is that. Obvious. Okay, we know these equations. Excuse me. Okay, so here's a quick example. If the Series A is a $5 million investment on a $5 million pre, they own 50% of the business at that point. And then if that business is doing well and you're raising a $10 million round and you say, okay, it was worth 10 million before, right? Because at the Series A here, we have after this money comes in, what's the valuation of the business at that point? Anybody want to? It's $10 million, okay. So then I put $10 million on 15, so the business went from $10 million valuation to $15 million valuation. Does everybody see how I got that from the slides on here? Or am I talking too fast? Okay. So the Series A, the $5 million investment and $5 million pre-money, you add those together and you get $10 million post-money. So between Series A and Series B, the value of your business is $10 million while you're spending that $5 million investment cash. And then when you hit Series B, you say it is now worth $50 million because I did all of this work to create value in the business, and that's why it's worth a lot more. And by the way, nobody's going to put $10 million in your business if you didn't make great progress. So. Okay, so then the Series A gets diluted down to 40% after that, or from 40% down to 30% once the Series B comes in. Okay, so then at this point, the VC owns 70% of the business. I know we talked about non-majority owners, but this example shows a majority owner. And then the business itself, your business that you've raised this $15 million in capital on, would have to be worth between $60 and $90 million so that the VC can get $85 to $130 million out of it. So your revenues need to be between $40 and $60 million. So I ran through all those numbers pretty quick, but the point here is this: you raise $5 million, you spend it all on product development, and then maybe you start getting some sales traction, and then you raise another $10 million. So you have to get to a $40 to $60 million revenue value, roughly speaking, in order for the VCs to make that make sense. The reason why it's important to think about these numbers is because if your financial projections don't credibly say this to the VCs, then it's just going to be a pass, because they're going to say, well, and there's, by the way, there's a ton of examples where you can say, well, I put $5 million into this business and it'll be worth $4 million after 5 years. It could be a fine business. I mean, it could run along just fine. It's just not venture investable. So I don't know if you've run across that issue at all, but it has to be a high growth business in order to attract that high risk capital. So, which is one of the reasons why you find a lot of VCs will sort of find like, oh, AI is hot right now. Let me jump on that because it's growing like crazy. And a lot of times, if you see kind of these trends that are happening, you can place bets in that sector, and that the tide is rising quickly in that sector, so you can take advantage of that. And as a if I'm trying to manage a bunch of investments, I want to make sure that whole sector is rising quickly, so I can pick a couple of winners in there, and then I have a much higher chance of success. So if I were to go into, say, manufacturing right now, it's kind of like, well, what sector in manufacturing is growing at any kind of rate close to AI? All of my limited partners are going to say, why the heck are you looking at manufacturing? Or why am I looking at instrumentation in biotech when this AI thing is really, really hot? So I know that can be frustrating for some people if you spent, if you get your PhD in some really, really cool quantum technology or something in the biotech space, and all these VCs are like, tell me about your AI strategy. That happens a lot, but now hopefully you understand why, because there's a lot of opportunities. Yes, sir.
So in this example, I don't see anything right now in terms of cost and expenses. How do VCs think about that, like burn?
Burn rate, yeah, that's good. That's a good question. I wanted to just quickly go through an example here. This is all equity investment, so there's no. It's not shown on the slide here, but the assumption is between Series A and Series B, you've spent that $5 million, right? And then after Series B, you've spent the $10 million to help grow the business. So this is just the equity side of things. By the way, I guess we have some MBAs in here, but it always bothers me that all these different financials things all come down to dollars. So like the example I was talking to my sister just got into bookkeeping recently, and I was like, your car is worth, say, $1,000. Why can't I just take part of my car and buy a coffee with it, right? Like those sort of silly sort of examples are like exactly the problem I think a lot of people have when they look at financials, because it's like, well, that's not equivalent, but still they're have the same units, right? It's a dollar value of a car that happens to be an asset that's sort of locked into this asset that I can't really liquidate, but cash in my wallet I can actually use to buy coffee with. So even though they have the same units, they're very different objects. And if anybody does any work in like the federal government, if you get inside the Beltway, they have this phrase called the color of money, where it's like, I have a certain money in this budget over here, but I can't really move it over to that budget. You have to start to think that way when you dive into these financials a little more closely. So let's get into it. How much time we got? Oh my gosh, we gotta keep going. Okay. How many have heard the phrase, prepare a standard set of financials? Anybody? Of course, my account has. Good. So a standard set of financials, again, just kind of this is what we agree is the right thing to do, is a balance sheet, an income statement, and a statement of cash flows. So the income statement is what you guys probably all know, which is also known as a profit and loss statement. And that's simply just how many things did you sell for how much money? How much did it cost you to sell that? Subtract the two and I get the profit margin that I got on that, right? That's how most businesses operate. And you have to have a really good income statement or whatever profit and loss statement in order to kind of get started on it. But the full set of financials is that income statement and the balance sheet and the statement of cash flows, and we'll go into those now. Balance sheet is just simply an assets and liabilities. So I think for most AI companies, your assets are the code that you've written and the laptop that you have, right? I mean, there's not a lot of assets in all that. It's much easier to think about kind of a hardware business where you have like a facility with a bunch of capital equipment in there. Those are all assets that you put on your balance sheet, and then you may have gotten some debt in order to buy some of the equipment, so you have some liabilities on there. That becomes important as you sort of grow the business out. And then cash flow. I always think of cash flows as the I don't have a beard, but if I grew a beard, I have a red beard, so I can say the redheaded stepchild or the redheaded cousin. A lot of people don't look at cash flows. I think the accountants look at cash flows. It can be important at the stage you guys are at. If you're just starting a company, it's do I have healthy cash flows or not? But you can get more and more sophisticated in terms of income from operations and investing and financing and stuff. Okay. One of my goals, and I'm happy to take feedback on any of this stuff, is to try and visualize financial statements more. Is anybody a visual learner here? You guys all like text, or you prefer? Okay, good. So I want to animate this, and maybe I'll do that in a later version, but this is you've got the profit and loss statement, so the profit from all of this stuff or loss flows into the balance sheet, and then the cash and cash equivalent from the cash flow statement flows into the balance sheet as well, so you can kind of see how things change, and you can kind of, hopefully can create movies from like month to month so you can see how things are flowing in your business. Anyways, one of the fun side projects, and it's much easier to do now with AI. So. Okay, excuse me. Let's do a quick income statement example. This is just a generic technology company, and for purposes of kind of, I guess, ease of understanding, we'll call it a hardware company. So we've sold $50,000 of something in the last month, and it cost us $20,000. So our direct and indirect costs, but not R&D, are 40% of the revenue amount. So we have a 60% gross margin, or gross profit, same thing. And then if you haven't heard the phrase COGS, sometimes people say COGS for cost of goods sold. This is the cost for the actual products you shipped, not all the other costs. So most of the time the costs are sales and marketing, research and development, and your salaries are not covered in that cost of goods sold, because we're talking about a product business here, not a service business. As you dive into the income statement more and more, you'll get a much better feeling for what business are you in and how are you structured. And it becomes a lot more intuitive, if you will. Most of the time, this kind of revenue minus cost of goods sold, that's where things start. And as long as as long as you're selling something for more than it costs you to make it, then you have a viable business. If you're not, then you don't have a business, or you have a charity, I guess. You're giving stuff away. And then from that, you take off the sales and marketing expenses. So what did it take to actually get those sales? Like how much did you have to spend to hire salespeople in order to get that revenue? And then what did you spend on research and development in order to kind of create the product and unique position in the marketplace for that? And then G&A, which I love the fact that it says rent, accounting, HR, and IT. G&A typically is the CEO's salary too. That's usually the biggest piece in the G&A. So, and oftentimes it's considered SG&A, so sales, general, and accounting. So the total expenses are 45%. So you end up with an operating profit, otherwise known as EBITDA. I don't know why I love the phrase EBITDA. I think it's like an accountant's way of saying they're cool, because what it stands for is earnings before interest, tax, depreciation, and amortization. So it's earnings before I've done all these other things to it. So it's like pure earnings. But I don't know why they would say earnings before. I mean, you could keep going, right? You could say before lunch, before dinner, but it's kind of silly. But anyways, that is the operating profit. So now you guys are cool. You can use the phrase EBITDA, or I think sometimes people say EBIT just to make it simple, like earnings before interest and tax, because that makes it just simple and pure. So the reason why you want to make this kind of a very easy to understand income statement is you have to start with the basics, and then any investor is going to want to see this kind of like raw numbers. So what are you selling? How much are you selling it for? And how much is it going to cost you? Let's start with that, and then we can kind of drive down and add more complexity to it later on. Any questions on that so far? Otherwise, we're going to get even more gritty, guys. I hope you guys are fully caffeinated. Yes? Mm-hmm.
Kind of desensitize towards them. But if you give conservative or normal valuation, then they would lowball it in a way. So how can one kind of balance it out?
Good question. So the question is, let me see if I can paraphrase. How do you manage kind of super high valuations versus reasonable valuations or lower valuations? Let me think. I don't think I don't have a slide on that, so I'll answer it right now. But I have a different view on valuations, and if you don't mind, we're going to go on a little journey before I answer your question, which is this: there's a silly statement that says it's easier to divorce your spouse than your investor, right? You probably have heard that, but I'll give you the specific example. If you're married and you want to have a divorce, you pool your assets and you split it down the middle, and that's where you start your negotiations, right? Like, okay, if I'm an investor and I give you $1 million, and now according to this, I expect 10 million, at least 5 to 10 million bucks out of it, and you spend the $1 million and you're like, you know what? Pound sand, I don't want you anymore. Okay, give me my $5 million because that's what I'm in here for. I gave you $1 million, I expect $5 million. Well, I don't have $5 million. I just spent the $1 million and we're down to like nothing. I'm eating, Campbell's soup. Go away. They don't go away until you give them the $5 million. That's the short answer of it. So you can't exactly like all of a sudden convert this and be like, here's your money, go away. Because of that, so if you think about that entire arc where you can't divorce, it's easier to divorce your spouse than your investor. Ha ha ha, that's funny. No, it's really, really true, and you really have to think about that. That means the amount of time you spend finding the right investors is more important than the amount of time you spend finding your life partner, right? So that's kind of I hate to equate those, the relationship and the sort of loving relationship with investor relationship, but to a certain extent it's true. So I would say if you have a couple of term sheets and one's super high crazy valuation and one's reasonable valuation, you just have to say to yourself, like, which ones look beyond the numbers, look beyond the funding that they're going to give you and the valuation they're going to give you, and say, do these guys have the relationships and the connections to the industry that I really want to get into? And these guys can open doors because they've been, they're in the investment level of all these other companies that would just completely, change the trajectory of my business. If there's, there's an obvious, these guys don't and these guys do, then whatever it doesn't matter what the valuation at that point is, in my opinion. I mean, within reason, right? Like, I'm assuming that these deals are kind of, that one's high and one's medium or whatever. So it's kind of 6 1 half dozen the other. You pick the team then, because that's what they're looking at you. They're saying, we're going to bet on the team because, yeah, you have all these wonderful financial projections, but I'm not really sure, how this thing's going to turn out. But when the bumps in the road happen, I want to make sure that this person, these people that are running the business are going to be able to handle it. So does that answer your question? I mean, sort of. Okay. Okay, so let's look at a 4-year income statement. So this is taken, all these spreadsheets are taken directly from that spreadsheet that's on that's downloadable. And one of the things, actually, let me just jump to that real quick before I dive into this spreadsheet piece. Where is it? Never mind. Okay. The one thing that I want to point out, if you guys are looking at the spreadsheet, is that there's a number graph, there's a color coding technique at the bottom that shows kind of the colors of each cell. So I don't want you to mess around with it too much because there's I think the red is for the input only. So they've done all of the equations behind the scenes and they've done a lot of the work. So you just have to think about what business you're in and be able to enter those in. Okay, so this is what investors look at. Top line revenue for the next 4 years. Okay, is this business going to make any money? We've got 1.2 million bucks, 11 million bucks, 41 million bucks. That looks pretty good. That's a pretty high growth business, right? The next thing they look at is kind of what are the ratios after the 4th year. So this means that you, as the person writing these financial plans, the founder, CEO of this business, are saying, this is what I think the business can be in 4 years. And if those match kind of what I want in terms of an IRR, then I can move forward to the next conversation. If there's anything less than this, then I'm just going to say, thanks, thanks for playing, goodbye. And then, what's the operating profit? And the key thing I want you to see here in this operating profit number is the year 1, I'm way negative, and year 2, I'm way negative, but then year 3, I turn positive. So that's and then if you just sum these two numbers, you could say that's the amount of money that you absolutely minimally need, in order to get this business off the ground. Of course, you don't want to just raise 3.3 plus 2.59 million bucks because then you have zero margin for error, right? You've got to be exactly right with what you said here. And as smart as you guys all are, I don't think you all can predict the future 3 years out from now. So I would definitely raise more than the amount that those sum to. Okay, and then what they also look at is the gross margin after 4 years to make sure, oh, this is a really high growth business and a really fat business. I like this business. Tell me more about it. So it's interesting when Bob was talking about pitching your business, and I love the problem solution, sort of strategy. I was always thinking, like, how big can this thing get, right? Like, where's the big numbers? Is it a high growth industry? Is it going to really be a big deal? And this answers that question for you in more detail, of course. Okay, now what you should look at, same thing as the investors, make sure the top line growth is growing and make sure the ratios are correct. But I want you to look at the first 2 years, because let's say, the investors put money in you, you're going to be faced with living these first 2 years. So whatever you put in those first 2 years, you want to make sure you're going to come pretty darn close to that. And a lot of times, it's very typical that every first-time founder or even many-time founders, you underestimate the cost of a lot of things and the time of a lot of things. So when we said earlier that the VCs don't believe this, that's because they're like, okay, well, you guys are underestimating the cost of a lot of these things. We don't know which ones they are, but we're guaranteeing that something is underestimated here. So, and then also you want to look at the ratios after a couple of years. Okay, so there's the standard set of financials, which has those standard financial sheets. There's also key performance indicators, which are really great ways if you dive into a specific business model of managing and monitoring how you're actually progressing. So in those first 2 years, when you want to really focus on making sure your business is growing as you expect, You want to make sure that it's following along in these key performance indicators. The things that I like in the SaaS world are things like churn rate, which is basically, you started a business, you're launching it online, customers are signing up for it. How many customers are staying and how many customers are leaving after 1 month, and then how much more money do you have to spend to attract new customers, and how is that working out? There's always going to be some churn rate that's expected, but is it a really high churn rate early on? And if you tweak some of the product offerings, and from the feedback, can you lower that a little bit? So that's a really good number to look at. Of course, monthly recurring revenue, committed monthly recurring revenue. So you guys have seen, if you go online and you want to buy a service and it says, do you want to buy monthly, for $100? Or do you want to buy a year up front for, $39, which would be crazy, right? But that's kind of how you can understand how the founder behind the scenes is saying, I need to get more committed monthly RR, and I'm gladly convert over and give a huge discount to all my customers to have them sign up for a full year because I have more committed monthly recurring revenue rate. Customer acquisition cost is basically just how much marketing dollars you have to spend in order to get one person to sign you up, and then once I get somebody signed up, what is the lifetime value of that customer? And those two numbers together can provide a lot more insight into the investors to say, okay, if you guys have a viable SaaS business, I can see how we can inject more capital into the marketing side of things to just simply grow and scale that business, and then the ratio as well. Same thing is true on the nonprofit side of things, donor retention rate, average contribution, and this kind of just gives you a sense of how much money do I have to spend in marketing in order to attract more donor money. And of course, if it's positive, then you can keep investing in marketing because you'll generate more income and more donations that allow you to sort of prime that pump, right? Questions on KPIs? Your industry will have a different set of KPIs. By the way, if you're out raising capital, you might ask that question of your investors to say, like, you guys invest in, hopefully you're talking to investors that are in your sector. Actually, you wouldn't have a meeting if they weren't interested in your sector. So if you're talking to an investor, then they are interested in your sector. You might ask that question of, like, in your portfolio of investments, what are the KPIs that your portfolio companies use that you like, right? That's a reasonable question, because then you can take that. It helps you understand how they look at businesses, and it also helps you kind of figure out how to run your own business at the same time. Any questions on that? No, we're good. Okay, so the business model. Has anybody pitched VCs and got the question, what's your business model? Anyone asked that question? Yeah. So I don't want to call you out, but I can tell you early in my pitching career, when you're a technical founder, which I am, and you get deep into it and you dive into the technology, and this is so cool, and you're not quite at the point where the person on the other side of the table's eyes are glazing over, but almost there. And then they'll say, what's your business model? And I finally realized, after it only happened maybe 30, 40,000 times, that really what they're asking is, how do you make money? Like, what are you selling? Who's the customer? Because that's a universal question that applies to all businesses, right? So it doesn't matter that you're geeking out on some quantum thing or some bioinstrumentation thing or some cool AI large language model inference optical engine or something. They're like, who are you selling to, and how much are they paying, and do they like it, right? Like, you can ask that question of just about any business and it would be a valid question. So if I don't understand the technology you're in, I'm going to ask that question, which you kind of heard Bob talking about, right? Like, what's the problem you're solving? Who is the audience you're solving it for? And why do they care, right? The thing after that is, okay, are they willing to spend money on it, and how much are they spending money on, and how many people do you have signed up to do that? And that drives your income statement then. It's also a blueprint of how your business will make money, and it's documented by the income statement. So, but I guess I want to say, if you get that question in an investor pitch, then I would just translate it in your mind to not what your business model is, because it can be a very complicated answer. I would just simply turn it around and say, this is, these are who my customers are, and this is how much we would charge for them, and this is what we would be selling to them. I would just answer it that way, and then you can get into other conversations once that happens. So, anyways, questions on that? No, business model. All right, so let's look at a couple of business models from, these are kind of older technology hardware companies, but, and these are normalized by revenue, so we don't have to say like how many billions there are here, but Cisco Systems has a cost of goods sold of 36%, so you can kind of just look across the board here. Look at this cost of goods sold, very high cost of goods sold, so the gross margin for Dell is super low. Medtronic is through the roof. Who knows about Medtronic, right? Very high biotech R&D. So let's see what their R&D percentage is. Actually pretty low R&D, 10%. Well, relative to Dell though, right? So Dell has a excuse me, low gross margin, low R&D cost. So this is all about execution, right? That's what that tells me, right? They have a low gross margin, a low R&D cost. They're like, I got to ship product out the door. Medtronic has a much higher gross margin and a bigger R&D percentage. So that tells me that they're probably thinking deeply and getting some deep patents and have some pretty cool and deep moats around their technology. Just from looking at the percentages of this, right? You can sort of intuit that out of the numbers. And that's how a lot of investors look at these things. Like, I don't really know what Medtronic does. I don't really know, I mean, I know Dell sells computers, right? But which computer and how does the technology work? I don't really know any of that stuff, but I can tell from the financials that probably that's kind of how they run their business. And then, Cisco Systems, look at this SG&A percentage relative to, EMC has a higher percentage of sales and marketing costs. So these guys are selling. Medtronic is selling too, I guess, too. And Dell, I guess, doesn't spend as much on sales as the rest of them do. So, okay. That's just a way to kind of look at various businesses. But keep in mind, these are not pro formas. These are actual financial numbers. So this is businesses that have been around for a while, and then you look at the ratios and you say, okay, this is the business they are now in, historically speaking. So you guys are looking at like pro formas, looking in the future to say, this is the business I'm going to be in, and this is what the business is going to look like. So what's my business model? Yes, sir. What is that?
What should a good ratio look like?
A good ratio for what business?
Oh, it depends on different industry.
Yeah. That's so all of these things, like Cisco's in networking, right? And Dell is PCs with a little bit of networking. These are all wonderful businesses, right? They're all throwing off a lot of cash, and it all just depends on how they want to run their business. So Dell has decided to be kind of an execution-focused business, and I think they have to be since it's so competitive. And Medtronic has always been in kind of deep R&D. So it's not a matter of which one's better. It's just they're just different, I would say. So yeah, sure. Other questions? Okay, let's jump into software, and this is sort of classic software, right? And you can compare this with kind of the hardware side of things.
Steve, could I just make a comment? If your model doesn't look like one of those and you're in the same business, then you better be prepared to explain why what you're doing is different and going to make money. So if you think of Airbnb saying, we're different, and here's why we're different. Because they can see all these kind of models, the numbers, and they're not going to believe you unless you have a good story that says why you should have a different result than people that have been around doing this. So,
yeah, that's really important because the other thing to think about and to keep in mind is most investors are pattern matchers. So when you come to them with a business and they're going to say, oh, you're a SaaS model, AI, biotech, whatever it is, they already have a set of patterns that they expect you to fit in. You may not know what they are, but that's kind of naturally how they operate. And I think that's how most people operate, just when you're trying to deal with like, I'm getting 10,000 calls a year for various pitches in different businesses. I have to fit them into different buckets. And the other side of it is exactly what Joe said. As soon as you fit into one of those buckets, you're going to immediately compared to all the proxies in that space. So that's why you see a lot of well, I guess, is there a copycat to Airbnb? There must be. There's several of them. Vrbo, I guess. Yeah. So you get like Uber, and then you get Lyft, right? Like, well, Uber worked. Look at how much money the investors made on that. We have to do that again. Let's invest in another business, and maybe it's competitive investors that wanted to kind of come into that second one. So let's take a quick look at software. Any other questions on the business model or Joe's comments? Okay. Yeah.
into? How would you ask that savvily or politically? Or,
You need to have a model selected before you go into it. What I would recommend you do is look at the industry that you're going into, and just look at all the businesses that are in there now and say, what model are they using? Because the answer is going to be, if the VC invests in that industry, they're going to know all those businesses already, and they're going to say, why don't you pick the model that they use, because then you look like all the rest of them, and we can just give you money and compete against all those guys, and then we can win, right? And by the way, I have used a lot of AIs, and I think they might be really useful if you just say, like, here's the business I'm in, what business model should I be? Here's my business, describe it in 5 or 10 sentences, and then say, what's the optimal business model, and what other competitors are in this? And are there any alternate business models that would make sense? So maybe just ask ChatGPT, right? Isn't that ChatGPT? Give me a lot of money. Okay, goodbye. We're good. Yes, sir. Can't see you back there. Mm-hmm. Yeah. I'm going to give you the cheat answer. Are you at MIT or Harvard? So MIT has PitchBook, which kind of has access to a lot. And by the way, if you don't know, library.mit.edu data sources, it's like a few $1 million worth of market research subscriptions that you guys all have access to. PitchBook, yeah. If you have an MIT credentials, then you should be able to log into the library and go. We get to. Yeah. You have to get a special login to get PitchBook access, but it's part of your tuition, so you should be able to get it. And it's for academic use only. Hopefully, I'm not violating anything. Joe, Esquire. PitchBook and what? Oh, I haven't used that one. So I was answering your question. That was the sort of cheat answer. Like you said, we don't have access to the private data. How can we get access to that? Well, if you can get access to the MIT thing, then you can get access to a lot of private. But some of it's not. Some PitchBook may not even have it, right? So if the proxies are private, that's a good question. I mean, if you can't, and PitchBook doesn't have it, you can certainly ask to try and figure out how to model it from other, other kind of, I don't know, other related industries around it to figure out what kind of numbers they might have. There was a study done many years ago. They asked some management consultants to say, how much of this top secret information can you figure out based on all of the information that's out there? And they said it was like 98% of what they were doing they could figure out from all the publicly available information and knowing that industry. You can also practice what I like to do, which is you go and find your list of 300 VCs that you want to talk to, and then you rank them, and you start at the bottom, and then you just ask the ones at the bottom, like, what business are these guys in? Sorry, we're not ranking. We don't do that here, but anyways. Okay. Okay, so let me just keep going here. I think make sure I get this done on time. Okay. So what is your product? How much you charging for it? We've already gone through this stuff. Okay, distribution strategy. So are you going to sell directly? Initially, yes. Of course, you're going to sell directly because you're the only employee of the business, or you and your co-founders are. You may have a distribution strategy later on. You may have sales partners, or you may have companies that want to rep your product and package it with something else. You may be a plug-in to an existing product line, and some company wants to do a deal with you and do it that way. That all falls into the income statement and needs to be modeled financially. So we'll do an example here in a second. R&D should end up 10 to 20%. G&A should end up 5 to 15%. Target operating profit of 15 to 20%. This is after 4 years. This is just kind of general rules of thumb for you to follow. And of course, if there's reasons why you're way out of this, it's fine as long as you have good arguments for why that is. So what you find is when you get into the details of due diligence of conversations around your financials is they just start to ask more probing questions. And if you have good answers for that, that's fine. But this is like a nice place to start your modeling from. Okay, first decision is how will you sell your product? If you have direct sales, so you're selling a $100 product, so you can book 100% of your revenue, Or if you're using a distributor who sells it for $100 and then gives you $80 when they make a sale, then you book the revenue as $80, which is basically 100% of your revenue. So if you compare this, what you find is the sales and marketing cost is $23 on the direct sales side, but it's only $8 on the indirect side. Isn't that great? It's so much cheaper. Well, what you don't see is that you actually only got $80 for the revenue. So it ends up being, what is that, $28 in sales and marketing expenses instead of $23. However, if I think about distributors, I think, wow, what a whole bunch of headaches that I don't have to deal with that they get to deal with. So I'd much rather pay $28 for my sales, especially early on, if you can convince somebody to rep your product for you. Okay. I don't recommend using business planning software. I'm sure you guys are using the heck out of ChatGPT and Claude and Gemini and the new Meta one and all that stuff. And that's kind of new this year. So I'll be very interested to hear how you guys are using it and what works well, what doesn't work well. When you build sales projections, always do it from the bottom up. So I've sold 3 products to this person. I've sold 10 to that one. I've sold 300 to that one. This is how much I charge them. This is how much I made from it. Whenever I hear the phrase, it's a $1 trillion market and we're gonna get 1% of it, I just immediately, it's like, no, you're not. Like, it's okay to do a top-down analysis in order to know that you're in the ballpark, because I have seen bottom-up analysis that are so aggressive that you're like, well, at that point, you're at 300% of the total market that's out there. So I don't think you're gonna do that, but okay. So you do the bottom-up projection to figure out what your sales are gonna look like, and then you do a top-down just as a sanity check to make sure you're not breaking any laws or breaking any markets or anything. How will you sell? How many salespeople? How long is the sales cycle? It's always longer than you want it to be because people take forever to make a decision on things unless you give it away for free, and then it's another question. So, I don't recommend projecting best case, worst case, but I do recommend you do that for your own sanity check, and then pick the one that you want to project, because you want to come in and say, this is what we're going to do, and show confidence in what your projections are, but then have a lot of reasons behind the scenes of why that is going to be factual. The VCs, when they're diving into due diligence, they'll do their own best and worst case, and they'll look at the worst case, and then they'll base their offer to you on the worst case. So, any questions on this? Yes, no, maybe so. Okay. This is Charlie's rule of thumb. I guess eventually I'll have to find my own rule of thumb here. So the building the financial plan is focused on attracting investors, and it's definitely, this is focused on technology businesses. If you're running a different kind of business, which I don't think anybody is. Does everybody have a service business in here? Or is everybody a technology product business? You have a service business? One of yours, but you're not going to raise capital for a service business. Okay. Anybody have a service business or a service? I mean, you could have certainly a product business that has service as an element or as an add-on to the product business. That's totally fine. But if the primary thing is a service business, the reason why investors don't like service business is because all of the value is in the people that are there, and at a moment's notice, they could all walk out the door. So, yeah, shoot. Yeah.
Relate from VCs to going after grants, both government grants and grants internally at MIT?
So I do a whole other talk on SBIRs, and I will give you one element of that, which is the VCs expect a return, and the government people that give government grants. Well, what did Bob say? Don't embarrass me. That's probably above the return is I don't want to get fired. I don't want to be embarrassed, and it'd be great if the company does well. So that's kind of the priority of, if you think about government contract people. I know a bunch of them. They're wonderful people. Well, is it? You don't want to be a jerk to them. I mean, anyways, okay, let's get back to this. Any other questions on stuff? Okay. Yeah, so the most common errors are the revenue is too high in year 4, and that may be the case for the one that I just showed you, where it was like ramping up, to $100 million in 4 years. I guess the AI companies can do that now. Back when we first created this was kind of crazy, but and the profit margin is too high. Typically, when it grows so fast and you have a really high profit margin, you'll end up having to spend a lot of money on infrastructure in order to keep up with that fast growth, which is why the profit margins are a little too optimistic. Yes, sir.
Yeah. Is the reason that why we call it error is you cannot keep it up in the future year, or is some other reason that counting make it an error as well?
Oh, is the reason why the revenue is too high in year 4, the reason why people project that out?
Why we call it an error? Is that just it's so high in the first 4 years, so it cannot easily keep up with the highest growth in the future, or some other reason also make it an error as well?
Yeah, I mean, if you look at people tend to project linearly but act logarithmically. Okay, so when you see these linear projections, it's like, okay, I can kind of believe it for a couple of years, but then after that, there's going to be something weird that's going to happen, and you're not going to be able to sustain that. If you guys are at Sloan and anybody's taking system dynamics in Sloan, there's these like reinforcing loops and correcting loops. So you always get these ramp up and then corrections and ramp up and corrections. That's kind of how the real world works. Now, if you go to the weird thing is if you go to an investor and you show this sort of up and down curve, they're going to be like, what the hell's wrong with you? So you end up having to present, this very steady, stable growth curve, but you both know that that's not going to work out that way. So, and that's where the communication happens, and that's where the kind of pushing on the assumptions and stuff happen. Yes.
Following that logic, would that be good just to have a linear growth, trajectory on the
linear growth, but not too crazy high in the 4th year, right? It's okay to keep it linear, but just don't make it insanely high. That's all.
Got it. Thank you.
Yes.
Be like this. Oh, hi.
Possibly, yeah, possibly. I've never done it, so you can try it.
If you're trying to look for a better spouse, whatever, like an investor of that relationship, you'd want to be really honest, and then like saying, yeah, you might want this, but this is what our projections are, that it's going to actually do this. Are you in for the ride?
So what I would recommend you do is
like screening out like good and bad investors.
What I recommend you do is to have on your slide just a nice straight curve, because you never know when those get passed around. You're not going to be able to have a conversation. But when you're having a conversation with somebody, you're saying, here's the projections, but what we actually think might happen is this, or they might push on you and say, well, what if this happens in year 3? What do you do then? And then you can say, well, then this isn't going to be as linear. It's going to be a little adjusted. And then you can have a dialogue about kind of how it's going to work and what your response is going to be to that. Because that's really ultimately what they want to know. Like, I can't predict every weird thing that's going to happen, but I want to know that if I'm giving you money, you're the one that's going to handle it when it does happen, right? Like, it's not about making mistakes, it's how you recover from them. So, make sense? Yes. When you press send slides, that goes inside a VC firm and it just gets sent all over the place to a lot of different people for different analysis without your phrases or without your context behind it. So whenever I send slides in, they have to hold the whole context in of what the message that I'm trying to send. Because I don't, if you have like an email that explains part of the slide and it's not in the slide, it can easily get lost in the fray. So especially if you're trying to do entry-level conversations. If you've already, if you already have a relationship and you're talking to them and you're down the path, then it's a lot more, it's a lot more tightly coupled. But in the early days, the VCs know that it's a numbers game, so they want to get in as many business plans and stuff as possible and analyze them. And they're using AI too, so you can easily just throw your business plan up to ChatGPT and say, I'm an investor. Would you invest in this? Poke holes in this and tell me how good it is and stuff, and see what it says. And then copy that thing and paste it over to Claude and say, Claude, answer these questions for me. I mean, why not, right? The only thing I can predict in 5 years of the AI industry is that Google and Microsoft will continue to hate each other. So why don't I just take OpenAI's tool and pitch it against Claude's tool and pitch it against Gemini and have them just fight for my pleasure, right? I mean, that's the best way to do things, right? I mean, and my knowledge too, right? I mean, ultimately, that's what you do. You ask 4 or 5 people that are smart in a sector and you get a consensus of opinion, that's probably right. So why don't I just, instead of those 4 or 5 people, why don't I just take 4 or 5 competing AIs and have them compete and give me the right answer? I do this, the secret, I do this all day long. Like, I'm constantly having AIs beat each other up and tell me what the right answer is. So, okay. All right, let's build some financial projections. Geez, we're running out of time. You guys are asking too many good questions. Okay. You know what, let's skip over the salary thing. That takes a little too much time, but generally speaking, if you're in a software business, salary is going to be your biggest expense. Sales projections of that in year 5, revenue per employee between 150 and 350,000 in year 5, and revenue per salesperson, if you're getting good ones, between $1 million and $3 million bucks. Happiness is positive cash flow. Somebody asked the question about burn. I think you asked that question about burn. Okay, now we're getting to that point. It's basically monthly operating loss plus capital expenditures. That's, you raise $1 million, it goes down every month because you don't have any revenue yet, and you're developing product, investing in product, investing in products. How long is that going to last? How much is your burn rate per month, and how much cash do you have, right? So it's like, and yes, I've seen it where some investors are like, oh, you have 6 months of burn left. Okay, well, let's talk in 7 months then. It's not really, then you kind of know that they're bottom feeders, right? They're trying to get a good deal out of it. So cash flow projections. Let's see. All right, let's keep going here. Okay, this is an important slide. The question is, how much do you pay yourself? They don't want you to starve, but they don't want you to make a ton of money off of the equity you invested. The return is in the equity, and you want to be aligned. They want you to be as aligned with them as much as possible. So your founder shares and their investment shares, that's where they want the value to accumulate. But they don't want you to be distracted by bills and other obligations. So you want, I love this phrase, minimum viable salary. Like, how much salary do you need to have in order, as the founder, in order to just take care of your rent and food and whatever other expenses you have. Like, this is what I need to have. And you can compare, be like, oh my God, if I were in industry, I'd be making zillions of dollars. Yeah, but you would have no equity, right? So you have to recognize that's what you're in for the equity. I've certainly seen it where people are like, founders are like, well, I'm going to take a super low salary, and they end up doing these like side consulting gigs and everything else. The VCs don't want that. They don't want you distracted. They want you focused on the business. So that's what I think this is a really good concept, that if you haven't thought about like what your minimum viable salary is, and it's probably going to be less than what you could get in the industry. So that's a good concept to think about where you are, and it would be anybody who's really high in the cap table should think about this minimum viable salary. If you have, if you're a new employee coming in, then you should have a market-based salary. And if they give you a lot more equity, they can give you maybe a little bit lower than marketplace salary. But that's generally a good rule of thumb. Let me skip over questions yet. We'll get to questions. Okay, so the end result is this. I have a bunch more slides in here. I'm not sure we're going to get to them. But I really wanted to point out that when you get the spreadsheet, it has a lot of tabs on it that are month-based and that they roll up to quarters. The red is the only input value that you have to give. You pick your business model, you pick your number of employees, you pick all the information on that. The magenta goes to another spreadsheet on it, or another sheet, and the black is calculated and the blue is from another sheet. So on this slide, you'll notice there's no red, so there's nothing input on this. But this is the 4-year profit and loss statement that was built up after entering all those things. Okay, and then this is the same slide I think I showed in the beginning, but this is sort of what it is graphically. So if I take, this is the ultimate, the operating profit. If I take these two negative values in this year, and if anybody likes calculus, you take the area under this curve, that's the amount of money that I need to invest in this business in order to make it grow. If I have zero margin for error. But then this also shows me like, okay, right here is where I hit break even. I don't need, this is the important thing I want you guys to think about as founders. When I say break even, that means freedom for you guys. So all of a sudden you are now running the business on your own, you're making money on your own. You don't actually need to go back to the investors for any more money because you're actually cash flow positive and you're growing. All of a sudden when you don't need the investors anymore, a lot more of them come. And they want to give you money because they see this growth rate and they say, oh, if I put more money in, will it go like this? Let's get some more money in this business and get it cranked up even higher. The biggest challenge is if you've raised $1 million, you've spent the $1 million, and then you have to go out and raise more and you don't have any money left. That's not a good scenario, because when you go and talk to investors and you have a sense of urgency of like, I'm starving, I need your equity in order to eat, that's not a great pitch, right? If you have this other pitch where you're like, I ran my business, it's now throwing off cash, I'm making money, I don't need your money, but let's make this even bigger, and I want your partnerships and I want your network, right? So the point about, you want to attract additional investors, so. Okay, so that's the same one that I showed you a second ago. Okay, so this is actually a dive into the kind of sales. So here's where you have the input. So you can just put in the number of units that you anticipate selling each quarter. and then what the cost per unit is. In this example, it's it's a $10,000 piece of equipment, or I guess it's $10,000. Yeah, this is a per unit price, so you're making $200,000. But all you have to do is enter in these per unit pricing things, and if you're going to have another model, in Model 2 coming in in year 2, then you can kind of price that out, and it'll add it all up for you. So it kind of contemplates 3 different products or models, and you can sort of lay it out. And then this also has built into it a support. So if you're selling, if it's a piece of biotech instrumentation and there's a support contract that comes with it, so there's an additional revenue stream that comes from the support side of things. And then the cost of goods sold, let's see here. This is staffing plan is built into this as well. So you can just add in these staffing numbers. And then you have a CTO, and then there's a salary in here at some point that talks about what the salary is for each person at each quarter, and that should just automatically add up and create your sheets. A lot of times, when the numbers don't look so great, you end up pushing off hiring. And what I recommend doing is going through the spreadsheet and creating your business and understanding the financials of your business and how big it can be. And then when you're comfortable with it, then presenting it to, there's probably some Sloanies who are investors that you can go pitch to some Sloanies and have them go, well, what about that, and what about that, and what about that, and ask you the sort of obvious hard questions, not based on any of the technology or any of the product, but just based on the financials, and get that kind of early feedback. That can be really valuable to say, where exactly am I in this? Because if you want to make the numbers look better, you can sometimes push out hiring, and they're going to say, well, why are you going to hire this person in year 3? You're going to need them here. It's like, oh, well, I need the money to do that, and that's going to make my numbers look worse. And anyways, there's a lot of iteration that happens and all that, and I highly recommend you do that, because once you have an intuitive, you can't really chat GPT your way out of credibility with an investor. So it'll help you enhance your knowledge and help you kind of figure things out and answer a lot of questions. But when you're sitting face to face with them and they're asking you hard questions about the financials of your business, you can't really just say, well, hold on a minute, let me just ask what ChatGPT says. Like, am I investing in you or am I investing in ChatGPT? Okay. Non-salary expenses are included in the spreadsheet as well, and you can play around with that. Let's skip over all the stuff. Let me see. Okay, I want to get to the last 5 minutes here. I want to get to So this is you should have a link to the slides on the website. The executive summary presentation suggestions about annual profit and loss up front for 4 to 5 years. That first spreadsheet that we showed that the investors are going to first look at and clarify, do we want to move forward with the next conversation? So as long as that should be first, and then the data that justifies kind of how you came up with your unit sales. You're going to make a product. What are you going to sell it for? Why? What do your competitors sell it for? What kind of margin are you going to get out of that? Like, those are all questions that I can ask. I don't even know what all the businesses you're in, but those are all valid questions for your business, right? We don't have any competitors. Don't say that, please. When will you be profitable, and what's your total cash requirement? Those are all good questions and good spreadsheets to have to kind of support all those things. And then if somebody asks you for a full business plan, which I'm not sure if people ask that anymore, but if they do, this is kind of what you want to have, which sort of boils down the kind of high-level annual P&L, and then quarterly P&L, and then staffing plan, and then quarterly cash flows. So, okay. Questions on the financial plan, because I want to talk about equity next, which is a really hard topic, and of course we save it for the last little bit. No questions on that? Let's talk about equity. Okay, let's talk about equity. Okay. So, unfortunately, I don't have any. I wish I had a silver bullet for this. It's a really hard topic. If you're a solo founder, you own 100% of the company. That's great, but it's probably not worth much. Maybe with AI it will be, but more than likely it's not. How do you split up the pie with your co-founders? How do you decide on your first hires and what kind of equity contribution they get? I was trying to think of, years ago I thought, why do we talk about pies? Because then it always feels like whenever you bring somebody else in, it's like, oh, my pie slice got less. Like, you're taking it away from me. And I was trying to think if it would be better to talk about slices of bread, where the first founder is one slice of bread and the second founder is another slice of bread. Then you bring on more people and you just get more, and then you finally have a loaf that's actually worth something. Because until you get to a loaf of bread, I have a slice of bread. Great, what is it worth? It's worth a slice of bread. It's not worth anything. Until you get like a full loaf. And then I was thinking, well, maybe I could do like, here's the founder's pie. He's got 100% of this, and then here's like the exit pie. He's got a big slice of this exit pie, and it's worth the area is much bigger than this little teeny pie before. So maybe I should stay with the pie scenario. Who likes the bread analogy? Who likes the big pie analogy? Oh, it's kind of split. Okay, all right, I'll do both. With ChatGPT, we can do both. Okay. Okay, so when you decide to distribute equity, you want to compensate for IP. So if you're doing a startup with a professor, the university is going to want some IP. But if you're going to get the professor on board as a co-founder, they're going to want some equity. And if they're going to provide some IP, maybe from a previous university or an outside consulting gig, they might have some IP they want to bring into it. That's one way to think about compensating it that you might do a special deal for. Commitment, which typically means you're not going to work for a competitor, right? You're committed to this deal. Usually that doesn't happen because there's a focus, but that's an important thing to think about because as you get started into something, a year goes down and all of a sudden other people are like, hey, that's a good idea. Why don't we start something and do that? And why don't we get that same professor that you were working with to come over to our thing? No, we don't want that. Risk. So as you'll see, the equity components go down as you raise more capital. So if I'm going to bring in a CTO after Series B, they're going to get a much smaller percentage of equity than if I bring them in like when there's no money in the business, right? So that's a huge risk when there's no money in the business, but it's a much lower risk when they're going to get like full market compensation, and they're going to get a much smaller piece of equity. So the sacrifice, like what's the market comparables? Like, are they reducing their salary so they should get more equity as a result of that? And then passive future contribution. The unfortunate reality is if they came and they bring in if some other employee that you're hiring on board has some great work that you want to incorporate in, usually the value that gets compensated for that in equity terms is a lot less than what is going to happen. That's just a reality of how things work. Excuse me. Your job as founder, CEO, is to maintain that internal equity to make sure that the people that are doing the work and taking the risks and providing the IP all get the right amount of equity compensation for it. And everyone should vest roughly 4 years because not everyone will stay. And that's one of the hardest things too when you have a team of like say 4 people that are getting together to start a company and one person wants to leave after a year. It's like, oh, okay, well, they have equity. Do they get to keep it or how does that all work out? Yes, sir. That is a great question, and I happen to have a slide and 2 slides that I'll talk about that in a second. So after 2 rounds of financing, the ownership is typically something like CEO at 5%, a VP at 1 to 2.5%. This is like the CEO after 2 rounds of financing, but if you are the founding CEO, you got to look down here at 2 to 3 times that, and the founding employees might get 5x to 10x these values. If they're a senior manager, right, they might get a lot more if it's like very early stage, before you've raised any capital. And you can always, if you have them vesting over 4 years and you realize that they should get some more equity, you can always grant more at a later date if it's like working out really well. And you do that sort of internal equity thing and you realize, ooh, this person's under, we're not giving them enough equity. I'm not going to go through this example. It's in the slides. It's a little bit of an eye chart, but it does go through kind of at founding what Jack, Susan, April, CEO, CTO, VP of sales has, and then how it gets diluted down as you see. I'm pointing at the screen here. That's great. As you see them kind of, you add more employees and they get some equity, and then kind of how the percentages dilute down. And the actual investment rounds are $500,000, $5 million, and $10 million bucks. So at the end of all of this stuff, what happens to the equity component? The CEO has 9.1% when they started out with 50%, which is again why I don't like that pie analogy, right? Their value the value of their holdings went up tremendously, but it still feels like a reduction because it went from 50 to 9%. So, okay, all right, I think that's it. Did I answer your question? I didn't answer your question. You asked a question about. Here we go. Okay, advisors, right down here. Board members, 25,000 shares per board member, and then. You had asked a question about, I thought I had it in here. I'm sorry. Advisory board members are typically a half a percent to 1% of equity, and it's vested over 4 years with typically a 1-year cliff. If they're really close to you and really strategic, and you can come up with kind of a statement of work of what you want them to deliver on a regular basis, you can kind of justify a little bit more. But I would definitely, and in limited cases, you might pay them some cash, but I would typically just get them. And if it's just somebody that you want to have on your slide deck for credibility purposes, the hard questions you have to ask are, is this the only company you're going to be on the slide deck for in this sector? And so if they're going to, they're going to commit to only doing that requires some some equity compensation to do that, right? If there's, but that gets a little tricky too. So I'm getting into stuff that Joe's getting uncomfortable about. So okay, I think that's it, guys. Any other questions? I don't want to go past 9 o'clock too far. So.
Hey, thank you, Steve.
Sure.
A lot. I just want to say a little bit about the model spreadsheets that are on the website. I was once in Istanbul doing some advising to a State Department, and there were a pitch team. I was listening to pitches, and there was this one company, a startup from Pakistan, and they were doing their thing, and they showed me their numbers, and I said, well, where did you get those? And what they had done, they didn't understand what I was saying. They had used this spreadsheet. And then later on, a friend of ours' daughter was getting married to a postdoc at Dartmouth, and he started a company. And when I'm getting to meet him, he said, I used the spreadsheet nuts and bolts, and I got funded. So I'm not saying it's the best in the world. Charlie put it together. But it is something, it's a useful thing to think about models. So thanks, Steve. You'll stick around for a little bit?
I will.
Okay.